Understanding what depreciation is can be very, very tricky because it's not something we encounter really as a consumer. So we probably have no life experience with it. So as a business though, we're going to get or have depreciation on quite a few of our assets. So what is it? Well, let's go back to the whole purpose of why does a business purchase non-current assets? Any non-current asset, doesn't matter what it is. When you think about it, the whole reason is to help the business generate revenues over a number of years. That's the point. Doesn't matter what it is. So let's just take a basic example. A business purchases a $50,000 delivery van to make deliveries to customers for the next 5 years. So here's our van, costs $50,000. We're going to use that to make revenues by delivering products to customers for 5 years. So basically, just come up with an estimate here. The van will enable the business to generate about $20,000 of sales every year. So every year that we have this non-current asset, it's going to generate revenue. Year 1, year 2, year 3, year 4, year 5. And that is the whole point of buying non-current assets. But I guess we need to ask now, if the van or any non-current asset is going to make revenues for many years, why, is there actually an expense from using the van every year? And if so, when was it? So is it a giant expense here? No. So this is the wrong thing to do. What would we do this? Would we have an expense of $50,000 for the van in the first year? We made $20,000 of revenue from using that van. So therefore the net profit from using the van in year 1 is actually a loss because it only made $20,000 of revenue, but it had $50,000 of expenses. But that must mean if we said the whole van was an expense in year 1, that must mean in year 2, the expense is 0. So now we made a profit of $20,000. And then in year 3, 4, and 5, we use the van again to make revenues, but there's no expense. We can't have revenues without an expense. We need to match our revenues with our expenses. That's part of the accrual basis assumption and also the period assumption. Each period there's a revenue here. We need to match that with the expense incurred from using that asset, and we don't have one in years 2, 3, 4, and 5. It makes no sense. So that is the wrong thing to do because the van earned revenues every year. So shouldn't we then go and match an incurred expense every year and not just in the first year? So that is what we need to do. So here's what we're going to do. When we purchase a non-current asset, we're going to think of it as a big tank of unused economic resources or benefits, kind of like when we prepaid an expense. And what we're going to do is use those economic resources in the future to earn revenues. So let's take the van again. It's a $50,000 van. And let's use the analogy that what we're really buying is a big tank or a big bin here of unused economic resources or benefits. And over time, we're going to use $50,000 of that, but at the time we buy it, it's unused. So what we really should do is as time goes by, we use the non-current asset to earn revenues. So in year 1, we use it to earn revenues of $20,000. Well, we'll probably use, if it's 5 years and it's a $50,000 van, we're probably going to incur an expense of $10,000 every year. And what that means is we're going to use a little bit of this van, 1/5, every year for 5 years. So what we should do is charge an expense in year 1 of the used economic resources or benefits. And that is actually what depreciation is. So in year 2, or in the first year, we'd say actually the net profit from the van, we earned $20,000. The $10,000 expense of depreciation, that was a net profit of $10,000. Another year goes by. We drive the van, we make revenues from it of $20,000. Well, we need to match an expense. So we've got $40,000 of unused economic resources here. Well, we're going to use another 10, and that would be our depreciation expense. So in the second year, our net profit would also be $10,000. And what we're getting here is a nice matching between revenues each period, $20,000, and the expense incurred of using the van every period, which is called depreciation of $10,000. So in year 3, what happens is we make another $10,000 of revenue, and then we use up another $10,000 of these economic benefits. So that's another expense called depreciation. And each year it's the same thing. We use up another $10,000, and then finally in that last year, we make $20,000 of revenues. We're going to use up the last bit of the van. It's called depreciation, and we've got a nice accurate net profit for every year. And what we can see is we have now used up all those economic resources or benefits. So what those economic resources are called when they're unused, it's an asset. And when they're used, it's an expense. So now all the expense has been used and there's no more asset. And basically what we just did is depreciation. That's all that was. This process is called depreciation. It's the allocation of a cost of a non-current asset for its useful life, is in how long will we use the non-current asset for. We'll come back to this term in the next video, what that means. So basically, if we have this delivery van here, we're going to earn $20,000 of revenue every year. We're going to match that with the depreciation expense each period. And that makes a lot more sense. We're going to get a much more accurate net profit here. So we've got a revenue from using a non-current asset, and then we match that with the expense of using the non-current asset. And what we do is we call this expense here depreciation expense. And you can think of it as the amount of the non-current asset that has been incurred during each period. I prefer the word consumed or used, but it's basically the expense incurred, how much of the van we consumed or used during each period. And we'll need to charge depreciation for all the depreciable assets of the business. What does that mean? It just basically means a non-current asset that has a finite or useful life, which must be depreciated over this life as it earns revenues. And we're going to get a lot of examples during our course, but some of the more common ones, we'll get IT equipment and computers, we'll get vehicles, and we'll also get machinery and equipment. But it could be any non-current asset we've come across in past questions. We might need to depreciate that, and we'll look at how we do that in the coming videos.